right, let's jump right into today's high-speed morning explainer. If you're navigating the financial markets today, you absolutely need a clear map of what happened overnight, along with those crucial intraday technicals. We're going to break down everything from the geopolitical macro weather to the exact support and resistance levels you need to watch. So let's get right to it. $120 billion. Yeah, that's a staggering figure, right? We're going to reveal exactly what this record-breaking number means for the Indian currency markets in just a bit. But first, we really need to set the stage with the broader global macro scene.
So looking objectively at the overnight geopolitical noise, we are definitely seeing conflicting reports about fresh missile exchanges in the Middle East. But here's the thing. Markets are heavily betting on containment. They're basically treating this as a recurring disruption rather than a full-scale war. And that is exactly what's keeping oil perfectly cool right in the mid-70s. Now that calm could vanish in a flash if the Strait of Hormuz faces a prolonged disruption, which could easily push crude back into the 80s or 90s. But for now, absolutely no panic.
Okay, moving on to the data, we've got a really mixed global picture to unpack. Over in China, producer inflation just hit a 4-year high, while consumer inflation is actually softening. That's putting some serious pressure on manufacturers. Contrast that with the West, which is showing real resilience. Germany surprised everyone with much stronger exports, and U.S. jobless claims, they just fell to a 6-week low. Today, that resilience gets tested again with German and French inflation drops, Canada's employment numbers, and the IEA's oil outlook all on deck.
Right, so let's see how all this data shakes out for the major currencies. Starting with the dollar index, the greenback actually slipped a bit as bond yields fell on profit booking. Meanwhile, Wall Street just kept climbing on an AI-led semiconductor rally, totally shrugging off those geopolitical worries. Now, a major fundamental soft point to watch here, Fed Chair Kevin Warsh just unveiled a heavyweight reform team. This basically signals that fixing the central bank's institutional plumbing is now just as critical as setting interest rates. Oh, and keep in mind, existing U.S. home sales showed a bit of unexpected softness too. So what does this actually mean for the charts? Well, your crucial line in the sand for the DXY today is the 100.47 pivot. As long as the US labor market stays resilient, backed by those low jobless claims we just talked about, the technical structure remains a solid, medium conviction buy on dips. You'll want to watch for initial support at 100.57 and resistance up around 100.89. Swinging over to Europe, the euro managed to recover as the dollar pulled back, pretty much ignoring any Middle East escalation fears. A huge driver for this was that surprising German export strength I mentioned a minute ago. On top of that, French and German data are staying broadly consistent with easing price pressures, right ahead of today's final CPI releases.
From a purely tactical standpoint, though, the euro's sell-on-rise strategy is really lacking momentum right now. So if you're trading this today, you've got to keep your stops incredibly tight. We're looking at support sitting down at 1.1388, with resistance hanging overhead at 1.1447.
Moving on to the pound, cable is outperforming once again. The fundamental driver here, falling oil prices are pushing UK 10-year gilt yields down at roughly twice the pace of US Treasuries, and they're now sitting at 4.90%. Plus, we're seeing some unexpected consumer resilience out there. UK house prices actually rose 0.6% in June. Who would have thought, given the severe fiscal restrictions, right? But you've got to remember this. Rating agencies are loudly pointing out that the UK simply lacks the near-term fiscal space for any market-disrupting policy easing. Because of that reality, the technical map is a clear buy on dips. Support is holding firmly in that 1.3393 to 1.3347 zone, and we're looking up toward resistance at 1.3450. Let's talk about the yen. Japanese 10-year yields slipped nearly 5 basis points from their decadal highs as those containment bets rose. But this perfectly highlights the ultimate dilemma for the Bank of Japan. How on earth do you execute monetary normalization without triggering a severe liquidity panic inside your own domestic banking sector? It is a massive tightrope walk. Yesterday's technical sell at 162.71 worked like an absolute charm. Today, we've got 2 actionable trades, including buying the dip at 161.94. But the main takeaway here is that this setup is heavily fraught with intervention risks. Seriously, trade this with extremely tight stops, ideally right around 161.70. Okay, this brings us right back to that massive $120 billion hook from the start of the explainer. Clearinghouse data reveals record cumulative hedging activity for USD/INR in June. Get this, importers grabbed $74 billion in protection, that's up 55% year-on-year, while exporters booked about $46.3 billion. That is a phenomenal amount of positional hedging sloshing around in the system. Technically speaking, the rupee strengthened below the 95.50 mark today. Now, this was heavily aided by a suspected RBI intervention, which just goes to show that sometimes the strongest market participant is the one that says the absolute least. With PSU banks selling capping further losses, the pair remains a solid buy on dips. Watch for initial support standing at 95.21.
Shifting gears to Indian equities, 1,962 crore rupees. That is the exact amount foreign institutional investors net bought yesterday. This rush of returned capital drove a really nice defensive comeback after 2-week sessions. It was mostly led by healthcare, FMCG, and banks, while mid and small caps comfortably outpaced the benchmarks in a broad-based, bargain-hunting sweep.
So the Nifty staged a volatile relief rally to settle up at 23,962. But here is the final pivotal question you really have to ask yourself today. With the market hovering right in the balance, will the critical 23,866 pivot hold to confirm a safe buy on dip strategy, or is it going to break and open up a bearish bloodbath? Keep your eyes glued to that 23,866 level today. Good luck out there and stay sharp.